Welcome to the entries and exits section of the course. The idea of entering and exiting a trade is easy, but to do it successfully can be challenging. And to be a successful trader, we must know how to properly enter and exit a trade. Before entering a trade, it's important that we are trading the London or New York session. Don't attempt to enter trades outside of these sessions, as trade volume is the highest during these sessions and normally low outside of these sessions. Right before the session opens up, it's okay to consider some trades as volume is just starting to generate. This time in the market is known as pre-London or pre-New York session. Secondly, be sure to check the news. This is critical because news can cause price to move erratically and ruin your trade. It doesn't matter how good your technical analysis is if price is moving due to news. I stay away from trading news. You must always check the news before even thinking about entering a trade. We can only enter a trade once we've defined where we'll exit the trade and how much risk we're willing to lose if the trade doesn't go in our favor. Never enter a trade without a sound reason to where you will exit or take profit, and always define where you will place your stop loss. If we enter a trade due to clean traffic, then we can consider to exit the trade at the end of the clean traffic, and our stop loss will be at the current candle low or the low of the previous candle. For example, here we have bullish price momentum in a range. We're anticipating price to break out to the upside. Looking left, we can see clean traffic above the range. If price breaks out and we're trading in a session which will provide volume, we can expect price to continue driving up to this first resistance here to the left, or even to the second resistance, which is the end of the clean traffic to the left. Let's place a take profit at the first resistance and at the end of the clean traffic. This will tell the market to close our trade once price reaches our take profit and secure our profits. In this scenario, we could place our stop loss below the low of the current candle, which is the same low as the previous candle. Our stop loss will close our trade if price reaches it. This is defining the amount we're willing to risk and potentially lose if the trade goes against our analysis. Let's see how this trade played out. Look at that. Price smashed our TP before potentially heading back down as the next candle is now bearish. This is why it's important to set a TP and stop loss. We want to secure our profits and not waste all our efforts. There's a saying in Forex, take it if you make it. Now let's look at what type of candles will prompt us to enter a trade and dive into more details on how we would enter this trade in the live market. There's one type of candle that will prompt us to enter a trade. A candle close confirmation, meaning the candle was able to close above or below the range. We must always wait for a candle to close above or below the range before entering a trade. Let's have a look again at the previous chart before it hit take profit. Candle close confirmation requires far more patience, but is well worth the wait. Here we can see that this bullish candle managed to close above the range. Now that we have a candle close above the range, we have grounds to enter the trade. But we don't just hit the buy or sell button. We wait for an additional confluence, which is the next candle creating a bottom wick and then returning to break the high of the current candle. Above the high of the current candle, we'll place a buy stop. Once activated, only then have we entered the trade. This extra confluence will ensure us the trade idea is valid. So, instead of instant market execution orders, we only take stop orders, buy stop for buys or sell stop for sells. So again, here's our take profit at this first resistance to the left. And now that we have this candle closure, we can place our stop loss just below the low of this candle. Now this next candle will open up and form a bottom wick. If it respects the low of this candle that managed to close outside of the range, it means that our trade is valid. We will place our buy stop at the top of the candle that closed above the range. Once price reaches this buy stop, then we are in the trade. And as we know, this chart already hit our TP. Nonetheless, let's say we didn't know that this price move was destined to hit our TP. Every trade requires trade supervision. Managing the trade allows us to mitigate risk and increase opportunities of profit. To supervise our trades, we consider four things: partial profits, runners, break even, and scaling down. Now, for partial profits, remember we had two possible ideal take profits set? That's because when we want to take profits, we should only close a portion of our position while bringing our stop loss into our entry point. This allows us to now have a risk-free trade, because if price decides to reverse and come back to our stop loss, it's now at our entry, allowing us a break-even trade. Consider it giving yourself the ability to win and risk nothing. And by only closing partial positions, this enables us to have a runner to continue up to the second take profit that we put on the chart. Let's see how that played out. Second TP was also smashed. The runner allowed us to maximize on top of profits that we already made, and the runner was risk-free. Now, let's look at scaling down. This is vital if our trade is going against us, as it allows us to mitigate risk even further. Here we have price in a range and it just printed a bullish candle. We define stop loss below the current candle and take profit at the top here. We want to take a buy trade. For some reason, we didn't wait for a candle confirmation, so no buy stop was set, but instead we took an instant buy with a market execution order. Let's see how this trade played out. The trade is going against us and is already at 75% of hitting our stop loss, meaning we're deep in drawdown. To scale down would be to close 50% of this trade transaction volume or lot size if we reach 50% drawdown in a losing trade. This means that we risk much less than we initially would allow for a losing trade. Now that we managed this losing trade, let's see what the next candle did. The next candle went even further down and smacked our stop loss. Thankfully, we were able to scale our lot size down and lost much less than if we never closed a portion of our losing trade. We close 50% of a losing trade when it's headed to our stop loss and not the full trade, because if our analysis is correct, it's possible for the trade to go back into our favor. If the losing trade decides to reverse and go back in our favor, we still have an opportunity to gain profits. Trade supervision is paramount for mitigating risk when entering and exiting a trade. It's the deciding factor of big profits and small losses. That wraps up the entry and exit section. I'll see you in the next section, Trade Setups.